Hey guys, I've been in Arizona for the last 3 weeks, so it's hard for me to record these market outlooks. So I've been sticking to the blog style format. But this week I'm trying to record a video on my laptop. Let's see how that goes. So let's start this week's market outlook with some charts. So the first chart we have is SPY, and in this particular chart I have just slapped some EMAs for you, and there is really nothing notable about this chart this week because all we are seeing is markets are just going up. SPY, DIA, QQQ, all of them are heading up. So the thing is, there was no bearish price movement in September. September did start with a pullback, but it got bought out. And then October started with a pullback too. But then what remains to be seen is, are we going to take our previous all-time highs and continue up from here? Or are there any signs of underlying weakness in the markets? And that's what I want to explore. So looking at the charts, nothing special. All it's telling you is SPY is going up, DI plus is going up, RSI is going up, everything is going up. If you switch to the regular indicator that I use, what we're seeing is Bollinger Bands are kind of contracting, beginning to contract. So this could mean a period of sideways consolidation. Frankly speaking, I'm not seeing massive momentum based push going up. So right now we are kind of stuck in a sideways pattern, if you ask me, and that makes sense because we have earnings season starting up next week. So until good earnings support this price movement, we are not going to make new highs. So that's what SPY looks like. Now let's look at some interesting divergence indicators. So the first one is TNX, or 10-year treasury yields. I haven't covered these in my market outlooks for some time, but if you remember from my previous market outlooks, TNX dropping, TNX is inversely correlated to the market. So when TNX goes down, markets go up. But what we're seeing is a breakout in TNX recently, starting October 1st. So I think that's a big sign of divergence. Let's see how it plays out, but something notable and something you shouldn't ignore. The other thing is VIX, Japanese yen spike, massive spike has destroyed my chart. I need some smoothing here to smooth out this huge 65 VIX. But if you remember, the level that I watch for is around here, 16. So if markets, as long as markets stay below 16, you are in a bull market and you are free to take more bullish trades than bearish. But any level above 16 indicates fear in the markets. If VIX stays above 16, what I usually tell our members is just become cautious. So if you have been bullish and you're making money, that's great. But if VIX is above 16, highly recommend that you cut down your trading volume. And then the other divergence indicator I want to point out is DXY. This is also just like TNX, US dollar. If you pull up the history, you will hardly ever find that US dollar is going up and the markets are going up at the same time. Just to give you a quick idea, so I've put two charts up here. One is DXY and one is SPY, and this is a 5-year weekly chart. And just for illustration purposes, you will see that when markets are going up, SPY is going up, DXY usually gets crushed. So DXY is going down. When DXY starts moving up, most likely a correction is about to happen or is already happening. So in this case, DXY starts moving up, markets are still going up. Note this period between October 4th, 2021 all the way to January. So this is a 3-month period. So DXY is going up, markets are going up. So that's divergence. And then DXY continues to go up and markets eventually pull back. And from January 1st, 2022, if you obviously you remember this is a bear market. So the entire year was extremely bearish, and DXY could have been used as a sign of divergence in this case. Now, this was a very obvious example. There are other cases. For example, DXY starts pulling back in October, and although this is a very zoomed out version, what we can do is if we just switch to, so this is a zoomed in version, 9-month daily chart of SPY. And the reason I'm showing you this is so you can clearly see how DXY and SPY divergence works. So starting October 13th is when market started going up in 2022, and from that point on all the way till December, for the next 2 months, markets went up. So that's what I was trying to show in this other chart, where DXY starts dumping on October 10th, and at the same time SPY starts moving up. Now again, just because there is divergence doesn't mean things are going to play out. There is no guarantee in the stock market. So but when these divergence indicators start showing up, you should start getting cautious. So we're at that point right now where SPY is going up, DXY is going up, TNX is going up. So I don't know how October will play out. October is also a seasonally weak month for the market. So the signs are there. The signs of divergence are there. It all depends on, all these inflation reports. For example, next week we have CPI, PPI, and then earnings season also kicks into high gear on Friday. So it does depend on a lot of other external factors. But as far as the indicators is concerned, this is what I'm seeing. Clear signs of divergence. We don't know when this divergence will resolve and when this will play out, but something to keep in mind. Okay, so now let's look at RRG charts, and I keep bringing up these charts every now and then to show you how money is flowing in the markets. So as you are fully aware, for the last, I would say, 2 months, XLK has been in the lagging quadrant, and if a stock or ETF is in the lagging quadrant, that means money is not flowing into that area of the market. So XLK, which is tech, has been in the lagging quadrant, and we are seeing evidence of that in all these high flyer AI stocks, which are not moving while QQQ has been moving up. So that's really interesting that Qs have been moving up, but none of the big high flyer stocks have participated in the recent rally. So XLK continues to be in the lagging quadrant. Energy XLE is also in the lagging quadrant, and everything else is moving into strength, which is all these Dow sectors. The XLP, staples, utilities, financials, healthcare, real estate. Everything has already moved into the leading quadrant. So one more thing I want to point out is, if you don't have access to RRG charts, which actually show you how which sectors money is flowing into, which sectors money is coming out of, there's another way of visualizing it. And what you can do is you can go to finviz.com. So this is finviz.com. What you can do is you can come up to this maps, and I really like the layout of this section. So when you choose that, it has already selected your map filter as S&P 500, and it's showing you 1-day performance. What you can do is you can say, I want to see 3-month performance. So now when you do that, now things start becoming much clearer what RRG charts are showing you. So what RRG charts, if you remember that I showed you, money has been flowing out of tech and moving into other sectors. So now the way this chart is laid out is you have this buckets. So the technology bucket, Microsoft is huge in that bucket, obviously, and these are its peers based on market cap: Oracle, Adobe, PanW, all these stocks. And then you have financials here, you have semiconductors here. Nvidia is the leader, obviously, and these are its peers in that area. And what you can see is this is what the RRG charts are showing you. For the last 3 months, Microsoft has been down 10%. I don't know if you have noticed that. Nvidia, which has actually made, has completely turned around after Jensen Huang made his recent comments that semiconductor demand is insane. Even then, Nvidia is still down 3%. Google is down 11%, Amazon 6%. So this is exactly what the RRG charts were showing you. Now, if you switch to 1 week performance, things have changed because Nvidia is moving up, Meta is moving up. So things are changing, but 1 week is too short a time frame to analyze. So it's best to stick to 1 month. As I've been saying, that Jensen Huang is the new Elon Musk. He can tweet or say one word and his stock turns around, and that's what's happening. So Nvidia is the leader of this bubble, and it has gone up 16% in 1 month. But uh, looking at 3 month performance, all the tech is in the red. So this is another way of visualizing where money is flowing in the markets. Quick look at the macroeconomic calendar for next week. So next week, all the action is concentrated between Wednesday and Friday. So if you look carefully here, we have minutes of FOMC meeting, September FOMC meeting, which will come out. So, markets love dissecting and analyzing everything that was said in the FOMC meeting. And this does bring volatility into the markets every now and then. And then Thursday we have core CPI, and then Friday core PPI. These, as you know, are huge market moving events. So Powell has already given us a 50 basis point cut. The jobs report on Friday was so strong that it almost sounds unbelievable to me and like a data error, but it is what it is. So if the jobs is strong and the CPI and PPI is under control, then I would even imagine that the Fed skips the next rate cut in the November meeting. So these two data points are really important next week. Let's see what happens. And finally, earnings. So earnings season is starting again, and we have JPM, Wells Fargo, and BlackRock reporting earnings next Friday. Usually all the banks report earnings, all the major banks report earnings on Friday, and this time it's not the case. So I think Goldman Sachs and a couple of other banks are reporting in the following week on Tuesday, I believe. Bank earnings will definitely generate a lot of volatility. So I highly recommend that you save most of your trading capital for Thursday and Friday next week. And finally, you guys must be curious about how the back testing and algorithm is evolving. I'm still working really hard on that, and the back testing is taking a long time. And because I told you in the last video that even if you change one small variable, you have to run back tests for every single year again. And one small variable could be, let's say, RSI tolerance. So if you want to change RSI from 70 to 65 to determine when your code thinks that the market is overbought, now that one change will cause me to run these back tests all over again. Examples are ADX tolerance. Examples are what EMAs am I using? What is my portfolio allocation range? So Am I trading between 5% to 40%, or am I doing 10% to 30%? So there are these, I would say at least at this point, 25 to 30 different variables that I have to experiment with to come up with the right formula. So going back to the back test, I will make a separate video of the back tests, but quick summary of how it's progressing. So I've made some changes. So what I did was, in the last video, if you remember, I covered 2020 and only SPY. Going forward, what I did was I also added SPY, QQQ, DY, DIA, and IWM to add some diversification. And I also tried all the sector ETFs shown below. So from my back tests going for last 5 years, what I've realized is adding too much diversity actually doesn't help. It drops the win rate of the algorithm. Now, just doing SPY, you could do that. You could only trade SPY. I don't have a problem with that. But I feel like it doesn't give me enough number of trades or enough data points to rely on the win-loss ratio that I'm seeing. So SPY, QQQ, DIA, and IWM gives me a decent mix of stocks or ETFs to do my back tests. So since last time, I've made a ton of changes in my algorithm, and I'll just quickly give you a summary of what I've been working on. So for example, I've introduced something called linear regression. Now, I don't know about you, but I was sleeping in my linear regression class in school. I wish my teacher had told me that I can use that to predict stock market trends, but I wasn't paying attention. So I had to go back and study linear regression. It is surprisingly helpful in predicting future trends. So I've introduced an element of that. I've introduced the advanced decline lines to so that the algorithm is able to gauge market depth when making decisions, trading decisions. I've introduced several VIX levels to gauge pullbacks, bear markets, all that stuff. EMA thresholds, I've introduced this concept of just not EMA crossover, but EMA thresholds. So what that means is, if your 8-day EMA is above your 34 EMA, that is usually considered bullish. But I've introduced this concept of threshold. How much does the 8-day EMA need to be above the 34 for my code to consider bullish trades? Similarly, I have RSI thresholds. I have played around a lot with allocation levels. So currently I'm ranging between 5 to 40%. So for example, if the market goes into bear market, I switch to only 5% of my portfolio. Now I'm again playing around with it. I may even drop it further to 2%, but the lower range, I drop it to the lower range in certain conditions. So when it's a bear market, when markets are going into a pullback in a bull market, I don't start buying put spreads. I actually drop my allocation. And the last situation is when I detect overbought conditions, I also drop my allocation levels. Then finally, when markets are coming out of a pullback, I ramp up the allocation all the way to 40% for just 1 week or 7 to 10 days to take advantage of a market recovery. But again, I'll go through all of this in detail in an upcoming video where I will show you the charts and the results and how these variables are affecting it. So I've made a ton of changes since my last video. So I ran the simulation for 2020, which is the last back test I shared with you, but it was only with SPY. This time there is SPY, QQQ, DIA, IWM. There are 4 ETFs in my simulation. So at least for 2020, the results are extremely promising. The win rate is 80%. It has gone from 70% to 80% after introducing all the variables that I showed you. However, I don't want to overpromise anything here because this is not a sustainable rate. I haven't seen anybody, frankly speaking, having an 80% win rate. That's huge. So the year that I just happened to pick, 2020, just happens to be the best year for my trend following algorithm. Remember, it's a trend following algorithm, so it will only do well when there is a clear trend in place. And in 2020, it did happen that after the COVID crash, the market just shot up like crazy. So that is why it's doing 80%. I did run some tests for 2018, 2019, and my results are ranging between, I would say, 56% win ratio all the way to 85%. So I think for 2019 it was 60%, and 2018 it was in the higher 50s. But one thing I want to bring your attention to it is this win rate. So in this particular example with contract size of 5, at 80% win rate, your profits are $31,000 for that year. That is a lot of money, because you can easily check how much money are you. This is for a really small account, by the way. So again, this brings me back to the 25K challenge. These numbers are achievable, but you just need a really good win rate. So if you drop the win rate 80%, let's bring it to 60% in this case, you made 20,000 and you lost 7,000. So you still made good amount of money. And the thing is, this is for a small account, so you're not risking a lot of money because each trade is only $250. And if you just take 1 month here, so this is February. So in 1 month you took 18 trades, approximately 4 to 5 trades a week. So you didn't take that many trades, and for that amount, this is a really impressive win rate, 61%. Now I'm still working on this, but even if you drop it, this is 2018, drop it to 56%, you are still making a decent amount of money. So what I've realized is my algorithm will not lose money as long as the win rate stays at 35% or above. At 35%, it actually breaks even. So the winners are equal to losers. So as long as I'm above 60%, I mean, that's huge. So that's going to work out really well. So anyway, don't want to go too much in detail about this because I will take one more year in my next backtest video and analyze the entire year and show you how the algorithm is progressing.